The first warning sign didn't come from a bank CEO, a Wall Street analyst, or a government regulator. It came from a tiny line on a monthly statement, barely noticeable unless you were looking for it. A checking account fee lowered, a new digital feature added, a credit limit adjusted upward by an algorithm that seemed to know you better than your local banker ever did. Quiet, subtle, almost invisible. But it marked the beginning of one of the most dramatic financial shifts of our lifetime. Banks losing ground not from a market crash or a scandal, but from an ambitious army of fintech companies that never bothered to build marble lobbies, hire tellers, or print checkbooks. If you look closely, you'll see this shift everywhere. The teenager paying for snacks with Apple Pay instead of cash, the small business that manages payroll, bookkeeping, and loans through an app instead of a local branch. The investor who hasn't spoken to a human advisor in years because a robo-algorithm manages everything automatically. And then there's you. Whether you know it yet or not, caught between two financial worlds that are rapidly pulling apart. This isn't a story about technology replacing banks, it's about a seismic rebalancing of power. For decades, banks controlled financial access. They dictated the terms, the fees, the schedules, and the processes. If you needed a loan, you walked into a branch. If you wanted to open an account, you waited in line. If you wanted to send money overseas, you paid high fees and waited days. The system was slow, expensive, and built on the assumption that consumers had no alternatives. But today, the alternatives are not only available, they're faster, cheaper, smarter, and designed to be frictionless. A fintech app doesn't ask you to wait in line. It doesn't shut down at 5 p.m. It doesn't ask you to come back tomorrow with additional documents. It gives you everything instantly, from credit scoring to financial planning to international transfers. And millions of people prefer it. Banks know it. They've seen the customer outflows, they've watched the deposit flight, they've felt the pressure as fintech startups peel away one profitable service at a time. Payments, lending, investing, budgeting, savings, insurance, business banking. The financial industry used to be a fortress. Now, it's Swiss cheese. But here's the real disruption. Fintech isn't just stealing customers, it's rewriting consumer expectations entirely. Once people get used to instant approvals, one-click transfers, zero-fee accounts, and predictive analytics, going back to traditional banking feels like stepping into a museum. Clean, historic, maybe even impressive, but outdated and out of sync with modern life. What's happening right now is not just a technological upgrade. It's a realignment in which financial power shifts away from institutions and toward individuals. Fintech companies figured out something banks ignored for too long. People don't want to deal with their bank. They want their financial lives to run in the background, quietly, smoothly, and automatically. This shift is especially visible in the way younger generations interact with money. They aren't drawn to the prestige of a big bank logo. They don't care about a branch on the corner. They care about speed, convenience, fairness, and transparency. They want financial products that adapt to them, not the other way around. And millions of people prefer it. Now, at this point, it's easy to think, okay, fintech companies are cool and banks are old-fashioned. So what? But the implications go far deeper. We are watching the early stages of a financial ecosystem where banks may no longer be the default choice. In the same way that Netflix replaced cable, Spotify replaced CDs, and ride-sharing replaced taxis, fintech is positioning itself to replace or at least overshadow traditional banking. And it's happening in ways that most consumers don't even notice because fintech integrates into daily life rather than advertising itself as a financial institution. Think about the last time you bought something online. Did you use PayPal, Klarna, Afterpay, Apple Pay, Google Pay? If you did, a fintech company, not your bank, handled the transaction, managed the data, and facilitated the payment. They earned the profit. They built the customer relationship. The bank was just the background infrastructure, quietly losing relevance. Every one of these small daily choices moves the financial world one step closer to a new status quo, one where the most important financial relationship you have might not be a bank. It might be a tech platform. And let's be clear, this isn't just a matter of convenience. Fintech companies are attacking the most profitable segments of banking: loans, payments, investments, and international transfers. These services traditionally generated billions for banks. Now, fintech startups are offering the same services with razor-thin margins or completely free, leaning on automation, scale, and data to make money in new ways. Look at lending platforms that use alternative credit scoring. They can approve people banks reject. They can price loans dynamically. They can analyze risk using behavioral patterns instead of outdated credit models. Their speed alone makes them attractive, decisions in minutes instead of days or weeks. It's no wonder consumers choose them. Or consider payment apps. Sending money used to require paperwork, delays, and fees. Today it happens instantly. The idea of paying $30 for a wire transfer feels ridiculous in a world where millions of digital payments move every hour at no cost. Then there's investing. Traditional brokerage accounts were filled with barriers, minimum balances, commissions, and confusing tools. Fintech platforms removed every barrier. They made investing as easy as scrolling on your phone. They turned financial markets into something accessible, understandable, and interactive. And once people experienced that simplicity, the old way felt prehistoric. The result? A generation of consumers who simply expect better. Faster services, lower fees, smarter systems, and more control. Banks can't keep up. Their legacy systems are too slow, too expensive, too complicated. Fintech companies move like startups. Banks move like ships.
But this shift isn't just happening on the consumer side. Businesses are jumping ship too. Small and mid-sized companies now run their entire financial operations through fintech platforms, payroll, invoicing, accounting, payments, and even business loans. These platforms understand the pain points banks ignored for decades. They design tools around real needs instead of bureaucracy, and businesses appreciate it. When enough businesses and consumers migrate, the impact becomes systemic. Banks lose fee revenue. They lose deposit growth. They lose lending relationships. They lose engagement. And most importantly, they lose relevance. And that's the real threat. Not collapse, but irrelevance. Banks won't vanish overnight. They still hold the majority of deposits. They still issue credit cards. They still serve as the backbone of financial regulation. But they're becoming utilities instead of experiences. Background infrastructure instead of the main attraction. Meanwhile, fintech companies become the interface, the place where people interact with their money daily. That means fintech owns the relationship, and in finance, the relationship is everything. What makes this transformation so unique is that it's not driven by a crisis or a scandal. It's driven by preference, by convenience, by the natural progression of technology into a field that resisted change for too long. And yet the biggest question isn't about banks or fintech companies. It's about the people watching this unfold. Where do you stand in all this? Are you adapting with the shift? Are you still operating like the old system will keep working forever? Or are you positioning yourself on the side that's gaining momentum every single year? Because whether you're a consumer, investor, entrepreneur, or simply someone trying to understand where the world is headed, this transition affects you. It affects how you save, borrow, invest, pay, and build wealth. Those who understand the shift early can take advantage of it. Those who ignore it may find themselves stuck in a system that's slowly losing its power. But before going deeper, one important reminder. This video is for educational purposes only and is not financial advice. The purpose is to help you understand how the financial world is changing so you can make informed decisions. Always do your own research. With that said, the disruption is far from over, and what comes next is even more important. Fintech companies are not just competing with banks, they're preparing to reinvent the entire financial experience on a global scale. And as this transformation accelerates, the gap between those who adapt and those who don't will only grow. What's fascinating is that most people assume fintech's rise is mainly about convenience, better apps, cleaner interfaces, faster transactions, but the real engine behind this shift is something far more powerful: data. Not the kind of data banks have relied on for decades, income statements, credit scores, transaction histories, but behavioral data that reveals how people actually live, spend, save, and make decisions. Fintech companies built their systems from the ground up in the digital era, which means they capture every meaningful interaction. Every time a user taps, swipes, checks a balance, pays a bill, moves money, or sets a financial goal, that data becomes part of an evolving model. And those models become incredibly accurate over time. They help determine the best time to offer a loan, the right way to structure a savings plan, the likelihood a user will overspend, or even the ideal moment to send a financial reminder. Banks, on the other hand, often operate on outdated data sets and rigid rules. Their systems weren't designed to adapt quickly because they were originally built to guarantee stability, not innovation. A banker can look at your credit history, maybe ask for your last few pay stubs, and run your information through a standardized algorithm. But that algorithm doesn't know that you've recently changed jobs, or that you're planning to move, or that your spending drops sharply every winter, or that you've started a business on the side. Fintech systems do. This difference matters because money is deeply personal. People want financial tools that adapt to their habits, not tools that demand they fit a mold. Fintech companies figured this out early. They realized that if they could understand customers more precisely than banks ever could, they could serve them better, cheaper, and faster. And once consumers saw the results, higher approval odds, fewer fees, more transparency, they stayed. And this technology-driven understanding of customers has led to something banks didn't expect, a new form of loyalty. Not loyalty to a brand or a reputation, but loyalty to the feeling of financial control. When a fintech platform helps someone avoid overdraft fees, or gives them personalized insights, or helps them build credit faster, they form trust. And trust is the currency banks used to dominate. Now, fintech companies are steadily earning it transaction by transaction, recommendation by recommendation. Just consider the shift in consumer mindset around credit. Traditional banks often treat credit like a gatekeeper. You're approved or you're denied. But fintech platforms treat credit as a dynamic system. They update credit data in real time, adjust limits automatically, and help users understand how their actions affect their scores. They encourage improvement instead of punishing mistakes, and that difference has changed how millions of people manage debt. The same is happening in investing. Banks used to give vague advice or push generic products. Fintech investing platforms analyze user goals, risk tolerance, and behavior to customize strategies on the fly. They turn investing into something anyone can understand, and that's why they're dominating. For many new investors, the idea of calling a bank advisor feels outdated, unnecessary, and slow.
And this evolution is accelerating because fintech companies move differently. They operate in an environment where competition isn't limited to local or national borders. A banking app in Europe can compete with one in the US. A payment platform in Asia can become mainstream on the other side of the world. Innovation spreads globally in months, not years. Banks, tied to regulatory structures and physical branches, can't match that speed. This global momentum means consumers now expect financial tools that work seamlessly everywhere. They expect to travel without foreign transaction fees. They expect to send money internationally without being charged something that feels like a penalty. They expect instant access to their funds, even across borders. Fintech companies build their systems with these expectations in mind. Banks simply weren't designed for it. But let's shift to the part of this story that often gets overlooked. Fintech isn't just challenging banks, it's forcing them to evolve, and not gradually, dramatically. Behind the scenes, banks are scrambling to upgrade their systems. Many are partnering with fintech companies, buying startups, or adopting new technology just to stay competitive. Legacy systems that once seemed reliable now look like anchors slowing them down. Some banks are spending billions to modernize their infrastructure. Others are trying to rebrand themselves as more innovative, more digital, more modern. Yet despite all this effort, the gap between what banks offer and what fintech companies deliver is still enormous. Banks are trying to retrofit digital systems onto old frameworks. Fintech companies started with digital frameworks from day one. It's like comparing a renovated house to one that was built modern from the ground up. No matter how much renovation you do, the structure still limits you. And consumers can feel this difference. When a bank app glitches, or a transfer takes too long, or an approval process drags on, people don't chalk it up to how banks work. They compare it to the apps that work flawlessly on their phones all day long. In a world where speed is normal, slowness feels unacceptable. But what's even more interesting is the emotional shift happening. People used to feel intimidated by banks. They assumed banks were the authority on financial decisions. Today, people feel empowered. They have data at their fingertips. They can compare rates, fees, and features instantly. They don't rely on a banker's recommendation.
They rely on transparency, reviews, digital advisors, and analytics. Fintech has democratized financial literacy by embedding education directly into the tools people use. Instead of reading long guides or scheduling appointments, users learn by doing. They learn through notifications that explain what just happened. They learn through charts. They learn through automated insights. And once people become financially literate through fintech platforms, they become less dependent on traditional banking systems. This shift in literacy also affects how people choose their financial providers. They're no longer asking, which bank should I choose? They're asking, which platform makes managing my money easier? And most of the time, the answer isn't a bank. But here's where this story gets even more transformational. Fintech isn't simply building alternatives to banking, it's building ecosystems. A single fintech platform might offer payments, budgeting, investing, savings, insurance, credit building, loans, and even tax tools. These interconnected features create a feedback loop where the more a user trusts the platform, the more they rely on it. The more they rely on it, the more data the platform gathers. And the more data it gathers, the better it gets at predicting and serving their needs. Banks have started to realize the threat in this ecosystem model because ecosystems don't just take one service, they absorb the entire relationship. If a fintech platform handles your paycheck deposits, your spending, your investments, your credit score monitoring, and your savings goals, what role does a traditional bank play? It becomes a storage container, and storage containers can be swapped easily. Fintech companies know that the future belongs to platforms that can integrate everything. That's why many of them are expanding aggressively, adding new services every year. Their goal isn't to be a bank. Their goal is to become the central nervous system of your financial life. Meanwhile, banks are trying to figure out how to slow the migration. They're offering new incentives, rolling out new apps, cutting some fees, and promoting their own digital features. But for many consumers, it feels like too little, too late. Once someone experiences the smooth flexibility of modern financial tools, going back feels inconvenient and unnecessary. The disruption becomes even clearer when you look at where new financial innovations happen. Almost every exciting development in finance, from embedded payments to AI-driven investing to blockchain-based settlements, comes from fintech companies, not legacy banks. Banks usually follow, sometimes years later. And that brings us to the core truth of this shift. Innovation now drives financial power, not size. For the first time in history, small teams of engineers and designers can outmaneuver massive institutions with decades of dominance. Consumers don't care about who is bigger, they care about who delivers value. And value today is defined by speed, transparency, and personalization. But this shift raises an important question. What happens next, and how does it affect your financial life, your opportunities, and your future? That's where the real story begins. Because fintech isn't finished disrupting the old system. In many ways, it's just warming up. The next phase will reshape not only how people bank, but how they earn, invest, borrow, build businesses, and participate in the global economy. And more importantly, it will determine who wins in the new financial landscape and who gets left behind. To understand the next phase of disruption, you have to look at how deeply fintech has already woven itself into the foundations of modern life. Every major shift in consumer behavior begins with convenience, but it never ends there. Once people adapt to a new level of speed and control, they begin to expect something even more powerful, autonomy. And that's where the coming transformation gets interesting, because the line between financial tools and personal empowerment is growing thinner every year.
Fintech started by simplifying tasks. Then it started improving decisions. Now it's moving into territory banks never imagined, becoming a personal operating system for money, something that doesn't just help you use financial products, but actively shapes how you interact with the financial world. And this evolution isn't theoretical. It's happening right now, quietly, at massive scale. For example, look at the rise of automated decision systems. These tools aren't just showing people their balance or spending patterns, they're making recommendations based on predictive analytics. They can identify when you're likely to overspend before it happens. They can suggest adjusting a budget category in real time. They can calculate your odds of hitting a savings goal and automatically adjust contributions. They can analyze your subscriptions and tell you which ones you forgot you're paying for. In some cases, they can negotiate bills on your behalf or automatically switch you to better financial products.
That level of automation isn't just convenient. It represents a complete reframing of what money management means. Instead of you managing your money, your system manages it with you. And once people become accustomed to this level of support, the idea of manually tracking expenses or researching financial products feels outdated and exhausting. Banks don't offer this kind of relationship. They offer products, accounts, cards, loans, services. Fintech offers behaviors, things that change how you live financially. And that difference is what's accelerating the divide. But automation alone doesn't explain the magnitude of this shift. The bigger force driving fintech dominance is integration. Fintech companies realize something early. People don't want multiple financial identities scattered across institutions. They want a unified experience. They want their savings to connect with their spending goals. They want their investment strategy to adapt to their income. They want their credit building to reflect real-time behavior. They want everything to work together in a way that feels fluid, not fragmented. Integrated platforms do this naturally. Banks struggle because they were built in silos. Different divisions handle deposits, credit cards, mortgages, business accounts, investment services, and wealth management. These units often operate independently, with separate systems and separate goals. Even if a bank wants to integrate everything, its structure makes that extremely difficult. Fintech companies, on the other hand, build features like puzzle pieces. Every feature fits into a broader system designed to make financial decisions easier. That's why a user can open an account, build credit, invest automatically, get insights, and apply for a loan all from the same platform without repeating information or navigating a maze of requirements. This seamlessness creates something powerful, momentum. When a financial system works so smoothly that it becomes ingrained in someone's daily routine, switching becomes painful. And in finance, switching costs are everything. Banks used to rely on the inconvenience of switching as a defensive moat. But fintech companies created the opposite effect. Switching is now easier than staying with a bank that feels slow, restrictive, or out of date. Meanwhile, as consumers shift their loyalty, businesses are shifting even faster. Small businesses, freelancers, creators, and remote workers are increasingly choosing fintech solutions because they actually solve modern problems. Instant payments, automated taxes, smart invoicing, cash flow prediction, payroll with one click, and financial dashboards built specifically for non-experts. Traditional banks never designed their systems around these kinds of needs because their primary customers were large institutions. Fintech companies built specifically for the new workforce, people who don't work 9-to-5 jobs, who earn income from multiple sources, or who start businesses from laptops. These groups are growing rapidly, and fintech serves them better than banks ever could. This shift in business banking is critical because once a business adopts a fintech platform, that platform becomes the backbone of its financial workflow. And once enough businesses adopt these tools, fintech companies gain something banks are desperately trying to preserve: relevance. But the next chapter of disruption goes beyond convenience, data, and integration. It involves something deeper: friction removal. Banks built processes with friction because friction protected them. It limited risk. It forced customers to conform to their systems. But fintech companies realize that friction isn't safety, it's inefficiency. And inefficiency creates opportunity for innovation. That's why fintech companies constantly look for ways to eliminate steps, automate tasks, and simplify processes that banks left complicated for decades. Something as basic as opening a bank account used to require a physical branch visit, identification documents, proof of address, and a waiting period. Now a fintech platform can verify identity using biometrics and public records within seconds. That's not a small improvement, it's a complete redesign of the process. And these process redesigns are happening everywhere. Loan approvals that once took days now take minutes. International transfers that took 5 days now take seconds. Investment accounts that required paperwork now open instantly. Credit evaluations that used outdated scoring models now adapt to real-time behavior. Every area of finance that was once slow, expensive, and painful is being reimagined through technology. And here's the most important part: people adopt to improvements quickly. Once instant becomes normal, waiting feels unbearable. Once transparency becomes the standard, hidden fees feel insulting. Once simplicity becomes expected, complexity feels like a trap. This shift in expectations is why banks are struggling. They're no longer competing against each other. They're competing against the best digital experience a consumer has ever had in any industry. And fintech companies intentionally design their systems to meet or exceed those expectations.
But this transformation isn't happening in a vacuum. It's happening at the same time a broader cultural shift is taking place, one where people want more control over their financial lives. They want to understand what's happening with their money. They want access to tools that help them grow. They want transparency, fairness, and efficiency. And fintech companies are delivering these values through design, software, and consumer-first thinking. All of this leads to the question many people are now asking: will fintech replace banks? The answer is more complex than yes or no. Banks aren't going to vanish. They're still essential for handling deposits, ensuring regulatory stability, and providing foundational financial infrastructure. But fintech companies don't need to eliminate banks to win. They only need to become the primary interface between consumers and their financial lives. And that's exactly what's happening. Think of it like electricity. Utility companies provide the infrastructure, but most consumers interact with devices, not the power grid. Banks may become the grid. Fintech platforms will become the devices people actually use. What this means is that banks will increasingly operate out of sight, while fintech companies control the relationships, the data, the insights, and the consumer experience. And once a company controls the interface, it controls the relationship. And once it controls the relationship, it controls the value. This shift has enormous consequences for financial power. In the old system, banks determined what products you had access to. In the new system, fintech platforms determine what tools you use, how you use them, and what opportunities you have exposure to. This moves financial decision-making closer to the consumer and further from large institutions. But it also brings new risks, because rapid innovation comes with challenges. Fintech companies must navigate regulation, security threats, competition, and trust. And as the industry grows, regulators are starting to pay more attention. Data privacy, cybersecurity, and transparency will become major battlegrounds in the years ahead. Despite these risks, the momentum is leaning undeniably toward fintech. Consumers are choosing digital tools at accelerating rates. Businesses are shifting their financial operations online. Global platforms are expanding across borders. And every year, fintech companies are developing new tools that redefine what financial empowerment means. This isn't just a technological revolution, it's a behavioral revolution. People aren't just using new tools, they're thinking differently about money. They're expecting more, they're demanding more, and they're moving their loyalty to platforms that deliver more. And we're still early in this transformation. The disruption we've seen so far is only the foundation. The next stages: automation, AI-driven finance, global digital networks, decentralized tools, and financial ecosystems will reshape not only how we interact with money, but how we participate in the economy itself. And this brings us to an even more important question. If the future of finance will be dominated by platforms that integrate, automate, predict, and personalize, what does that future look like for individuals? What opportunities will exist? What dangers? And how can people ensure they're positioned on the right side of this massive shift? The future of finance isn't going to be determined by who controls the most branches or who has been around the longest. It's going to be shaped by who can best integrate themselves into the daily rhythms of people's lives. And as fintech evolves from a collection of apps into a full-scale financial ecosystem, the question shifts from what tools do people use to what systems do people trust with their financial identity. We're entering a phase where financial identity, everything from spending habits to savings goals to risk tolerance, becomes dynamic and portable. Instead of relying on a rigid credit score or a static financial history, your financial identity will be an ongoing model, updated in real time. It will reflect not just how you behaved in the past, but how you behave now, how you might behave tomorrow, and how well you adapt to financial opportunities. Fintech companies are already building these adaptive financial identities using machine learning and behavioral analytics. These systems can analyze patterns that traditional banks can't.
the timing of your purchases, the stability of your side income, the consistency of your saving habits, the flow of your business transactions, even subtle indicators like how often you log in or check your balances. These details create a fuller, more accurate picture of financial reliability than any single number ever could. This is transformative because it breaks the old system where people were boxed in by outdated scoring models. In the traditional system, a late payment from years ago could still affect your opportunities today. In the emerging fintech-driven system, your financial identity is far more forgiving and far more reflective of who you actually are now. That means millions of people who were previously overlooked, underserved, or wrongly categorized by traditional banking metrics suddenly have access to better financial products. But this new model does more than offer fairness. It offers fluidity. Your financial identity will move with you across platforms, adapting as your life changes. If you start freelancing, your identity adjusts. If you take a risk and invest more, it adapts. If you cut your expenses and start saving more, it responds. It becomes a living profile that evolves with your decisions instead of reacting to them years later. This fluid identity lays the groundwork for an entirely new financial experience, one where every product you interact with can personalize itself instantly. A savings account could adjust interest tiers based on your patterns. A loan could adapt its terms dynamically. An investment portfolio could shift based on your goals without you lifting a finger. Insurance premiums could reflect real behavior instead of assumptions. This is where fintech is headed, full customization at scale.
And when financial tools become as personalized as your social media feed or playlist, they stop feeling like services. They start feeling like extensions of your thought process, quietly guiding, supporting, and accelerating your financial momentum. But personalization isn't the only driving force in the next wave of fintech. Another major force is decentralization. The idea that power, control, and opportunity shouldn't be concentrated in a handful of institutions. While decentralized finance has its volatility and risks, the underlying philosophy is reshaping consumer expectations. People are increasingly drawn to systems that offer greater transparency, lower barriers, and more ownership over their financial assets. Even fintech companies that are not fully decentralized have adopted these principles. They build systems that are more open, more interoperable, and more aligned with user control. This shift encourages more competition, more innovation, and more pressure on banks to modernize or step aside. One example of this decentralization mindset is the rise of embedded finance. Instead of needing a bank for a loan or a payment system, people can get those services inside the apps they already use. Shopping apps, travel apps, food delivery apps, ride-sharing platforms, and even social media. Payments, credit, savings, insurance, and investments are becoming embedded into daily activities. This changes everything. When financial tools disappear into the background of everyday life, the question of which bank do you use becomes irrelevant. The bank becomes invisible. The platform providing the experience becomes the only relationship that matters, and fintech companies are the ones building these invisible networks. The more invisible finance becomes, the more influence fintech gains, because the most powerful systems are the ones you don't notice. You just use them, effortlessly, without thinking. That means fintech companies are not only integrating into daily life, they're shaping the habits and expectations that define how people interact with money going forward. This leads us to another monumental shift: global interoperability. In the traditional banking system, borders mattered. Sending money across countries required paperwork, delays, and high fees. But fintech platforms are dissolving those barriers. Digital wallets, global payment networks, worldwide investment platforms, and cross-border financial tools are making the world financially connected like never before. Imagine a world where your financial identity, assets, and accounts follow you anywhere, instantly. That world is being built right now, piece by piece, through fintech infrastructure. A freelancer in Brazil can get paid instantly by a client in Canada. A traveler can spend money abroad without hidden fees. An investor can access global markets from a single app. These capabilities are not future predictions, they're current realities gaining scale every year. Global interoperability isn't just a convenience upgrade. It shifts financial opportunity from local to global. People aren't limited to their local banks or local markets. They can participate in global finance without needing specialized knowledge or connections. This creates a more level playing field, especially for people in developing countries or emerging markets.
And as more of the world comes online financially, fintech platforms will become the primary gateway into the global economy. But global empowerment also brings another trend to the forefront: the rise of alternative income systems. The traditional economy revolved around salaries, stable jobs, and predictable financial structures. But the modern economy is far more fluid. People generate income through side businesses, remote work, content creation, online sales, freelance projects, digital assets, and countless other sources. Banks were not designed for this world. Their rules and systems assume that people's financial lives are predictable. Fintech platforms were designed for unpredictability. They adapt to fluctuating incomes. They offer tools for managing irregular cash flow. They help creators, entrepreneurs, and remote workers operate financially without the burden of rigid requirements. This adaptation is crucial because the global workforce is shifting. More people are becoming independent workers, small entrepreneurs, or creators. Fintech companies recognize this and are building financial systems that support flexibility rather than punish it. And as more people move into these alternative income systems, the platforms that support them gain power fast. As fintech becomes central to how people earn, save, borrow, invest, and build wealth, the question becomes, what role will banks play in this future? The answer is that banks will likely remain the underlying infrastructure, the plumbing, that keeps the system running. But the interface, the innovation, the user experience, and the customer relationship will belong to fintech. Banks may hold the money, but fintech will hold the customer. And in finance, the relationship is what defines influence. But this future isn't determined solely by companies. It's shaped by consumers. Because ultimately, the biggest disruption of all is happening in people's minds. People are no longer afraid to explore financial options. They no longer assume the most established institutions are the safest. They no longer tolerate friction. They no longer think about banking as a physical destination. The shift in mindset is the real revolution. Once a population changes how it thinks about money, the system must evolve to match that mindset. That's exactly what's happening now. Yet this shift also raises some critical questions. If fintech is becoming the new interface for the global financial system, what should individuals do to position themselves on the right side of this change? How should they prepare for a future where traditional stability and digital innovation collide? And how can they take advantage of the opportunities that come with a financial world that's more open, more automated, and more global than ever before?
The answers lie in understanding how to adapt, not react. Because in the final phase of this transformation, the greatest advantage will belong to the people who understand the new rules before everyone else does. If there's one truth shaping the future of finance, it's this: whoever controls the interface controls the customer. Banks may control vaults, but fintechs increasingly control attention. And in a world where attention decides everything, from what you buy to how you invest, that shift is far more powerful than most people realize. Because once you control the interface, you don't just deliver services, you influence behavior. You steer decisions. You design incentives that pull people deeper into your ecosystem. And you build habits that are nearly impossible to break. That's why big banks are scrambling to reinvent themselves. They're not just losing customers. They're losing habit loops they once dominated for generations. The interesting part? Fintech is evolving so fast that even fintech itself is being disrupted. There's a new wave building, a world where finance blends invisibly into technology, where money management becomes as effortless as scrolling a screen, and where the companies winning aren't necessarily financial companies at all. And that brings us to the question people rarely ask. What does the endgame actually look like? What happens when fintech truly eats banking? And what does that mean for anyone trying to be on the right side of this transformation? To understand that, you have to look deeper than features, deeper than apps, deeper than convenience. What's happening is a complete rewiring of financial power structures. And unless you step back and see the full picture, you end up missing the most important opportunities and the biggest risks. Because the real story isn't that fintech is replacing banks. The real story is that fintech is replacing the relationship people used to have with banks. And once you replace the relationship, you replace the loyalty. Once you replace the loyalty, you replace the institution. And once you replace the institution, you rewrite the rules. This is where everything is headed. A world where the financial system isn't built around banks, but around platforms.
Platforms that bundle services instead of siloing them. Platforms that turn users into communities rather than accounts. Platforms that monetize behavior instead of balances. Platforms that can move faster, learn faster, and adapt faster than any traditional financial institution ever could. And here's the twist. These platforms aren't even necessarily financial companies. They might be retailers. They might be telecom companies. They might be social networks. They might be artificial intelligence ecosystems. The next bank might not look like a bank at all. This is the final stage of disruption, when the industry being disrupted can't even recognize its future competitors. If you want proof, just look at the direction the world is already heading. More than half of Gen Z would rather manage their money through a tech brand they trust than a traditional financial institution. Many don't even know the difference between a bank and a neobank. And more importantly, many don't care. To them, the best financial service is the one that gets out of the way and lets them live their lives. So what does the financial landscape look like when this transformation fully matures? You'll likely see 4 major shifts happening simultaneously. The first shift is financial services going fully embedded. Not partially, not optionally, fully. Money will move automatically between accounts for optimization. Payments will route invisibly behind the scenes. Credit decisions will be made in real time, based on data flows rather than applications. Saving, investing, borrowing, these won't be separate actions anymore. They'll be functions happening in the background of the apps and platforms people already use every day. The second shift is hyper-personalized finance. The days of one-size-fits-all banking are over. In the future, your financial experience will look nothing like anyone else's. Your platform will know when you're overspending, when you need credit, when you need to save, and when you might want to invest. Not because you asked, but because the data signals it sees are unmistakable. This type of personalized insight has existed in pockets for years, but Fintech is bringing it to scale, and AI is accelerating it to levels banks simply aren't architected for. The third shift is invisible credit. Credit won't be a product you apply for, it'll be an attribute embedded within the platforms you use. When you need to buy a product, credit will appear. When you need to delay a payment, credit will adjust. When your cash flow dips, credit will expand. All automatically. All based on behavioral data far richer than the static credit systems banks rely on today. This alone rewrites everything from retail banking to consumer lending. And the fourth shift is the rise of new financial identities.
Your bank account used to define your financial life. Now, your digital profile does. Your spending patterns, your online behavior, your loyalty program activity, your subscription history. These are the new indicators of financial trust. And the companies that understand these signals best are the ones best positioned to offer financial products. Which means the institutions with the most data, not the most deposits, will control the future of finance. Now, this shift comes with opportunities, but it also comes with real risks. When finance becomes invisible, it becomes easy to ignore. When money moves automatically, it becomes easy to overspend. When credit becomes frictionless, it becomes easy to fall into patterns you didn't notice. And when platforms hold more control, it becomes easy for users to underestimate their power. This is why financial literacy becomes not just important, but critical. The future doesn't just reward convenience, it punishes complacency. If you don't understand how these systems work, they will shape your behavior without you noticing. And even if they're designed with good intentions, no system that powerful should ever be left on autopilot. That's why the question, are you on the right side, matters more now than ever. Being on the right side isn't about picking the winning app. It's not about predicting which fintech company becomes dominant. It's about understanding the new rules of engagement. The right side is the side that recognizes where the leverage is shifting. The right side is the side that sees data as the new currency. The right side is the side that adapts early instead of reacting late. The right side is the side that stays informed, not overwhelmed. Because the biggest risk in times of disruption isn't losing money, it's losing awareness. And as banking continues to evolve, the people who win will be the ones who learn how to think like the builders, not the users. People who understand how incentives shape behavior. People who can see the patterns before they become mainstream. People who recognize that the gap between technology and finance isn't closing, it's disappearing. So what do you do with this information? Stay curious, stay educated, stay aware of how your financial habits are influenced. Learn the systems before they learn you. And most importantly, stay adaptable, because the financial world you grew up with is not the financial world you're going to retire in. The future of banking is already being rewritten, and you are living through that rewrite in real time. You don't have to become an expert. You don't have to analyze every shift. But you do need to understand that the system is changing, and the earlier you position yourself with knowledge, the more the future works in your favor. Because financial disruption isn't a threat to everyone. For some, it's the biggest opportunity in decades. Technology has leveled the playing field in ways traditional banking never allowed. And if you're willing to learn, even a little, you put yourself on the right side of a transformation that will reshape the next generation of wealth. This is educational content only and not financial advice. Thank you for watching.